All right, folks, welcome to Investing for Beginners podcast. Today, we're going to answer a great listener question we got recently. Newsletter at einvestingforbeginners.com, which is a great place you can send us any questions you might have. So, this is from Perth, Australia, and they're responding to a request that we made in one of the episodes regarding suggestion for future episodes. And they said, it would really help me and hopefully lots of other investors if you could have an episode that deep dives into portfolio construction and management. In particular, could you please share your thoughts on the following? I'm not going to read all of them because there's a lot here, but how we structure a portfolio, including allocation, sizing, how many companies, and portfolio management. The person's name is Ashish, and again, they're from Perth, Australia. So this is a great. With that, maybe let's start. Like when we're talking about portfolio construction and management, when I say those words, what does that mean to you?
It's just how big are each of the stocks in my portfolio? How many stocks do I have? Those are the two main questions.
Yep, exactly. When we're trying to think about structuring a portfolio, how do you think about allocation into each new company?
Yeah, I mean, I'd be curious. I'm just a guy, right? I'm just one guy with a portfolio. So the way I do it doesn't necessarily need to be the way other people do it. But if we think about the spectrum and the extremes of how people do portfolios, I think for each of these topics that Ashish brought up, which are all excellent, thank you for writing these in, I fall on different sides of the spectrum for each of these topics. So I think it'd be useful for everybody if I'm happy to talk about mine, but then also talk about maybe some of the extremes on either side. And hopefully that breakdown will be educational. Allocation into each company. Like, I'm a math guy, I'm a probabilities guy, I'm the guy who's watching Survivor, and when they have to decide between taking a risk or not, I'm the one telling my wife, see, they should have taken the risk because if you add 0.33 to 0.5, then the probability is over 75%. You should take that bet every single time. I'm that guy. So when I look at portfolio and company allocation, I have all of those things in mind. So for me, I've settled on some guideposts to what I'm trying for different sizes. And I break it down into, I have a full position size, I have a starter position size, and then I have sort of like a feeler, not even a starter. It's like a prospect. I'm just dipping my toes. So if I'm looking at a full size, I want something around 6.25. If it's starter size, I want something 1.5% for each of these. And then the prospect can be the prospect. So I am definitely thinking about portfolio construction a lot. I'm definitely thinking about allocation a lot. And I do believe it's very important. And not only do I believe, but it's been proven through track records of many, many investors that it is very, very important. You don't want to be the best stock picker in the world, but not be able to benefit from that skill because you don't have enough allocation. So from the extremes, you have people who are like Charlie Munger, who has 4 positions, all the way to somebody like Tom Gayner has 250 something, I think. So that's kind of the spectrum. What are your thoughts on either of those extremes? And, do you have ways you think are better for average investors?
I really like that of how you said it, and that's roughly kind of the same way I think about it. A 5% position, for example, and then maybe I have a 1 or 1.5%, and then what I call skin in the game, like just buying a very like you said, it's dipping my toe in the water. It's a very small. Just want to check it out, see if that encourages me to learn more about. For me, that's a comfortable way to do it. The way that Charlie does it, I admit when I first got into the whole investing thing, that made a lot of logical sense to me. But then when I started experiencing the joy of picking poorly and making bad investment decisions, I realized that it sounds great on paper. But as you get more experience and older, maybe you can arrive at that kind of level of concentration. Some people can do it early on, and more power to them. But I think just the average person, because of the vagaries of investing and the craziness that goes on, in between our ears that affects so much of what we do. I think being that concentrated is very, very challenging. I'm not saying that people can't do it, but I would say, if you had to look at the broad spectrum of investors, say, on the right hand side, you have that 1.5% people that can do the Charlie concentration. And then a vast majority of us sit in the middle. And then there's other people that go, the Tom Gayner, Joel Greenblatt, Gardner route of 350 companies in their portfolio. And I think the bottom line is when you're trying to, it comes down to what are you comfortable with and what works for you, for your mindset, and how the best way to do it is. And that's kind of what I settle on.
And the allocation and the percentages, those help form how many companies to own. That was the next topic from Ashish. How many companies to own? Well, it depends. If you're 5% position like Dave, that's 20 companies. 5% times 20 is 100%. You can't allocate more than 100% of your portfolio unless you are using margin or leverage. And we do not ever recommend trying to do that.
Ew. That is a time bomb waiting to happen.
Yeah.
So I guess when I'm thinking about investments, I haven't bumped up against this yet, but maybe I will at some point. Like, how many is too many? To a certain extent, what Tom Gayner is doing, 250 companies, there's literally no way he can track all those himself. And so I wonder about that. I'm not trying to disparage Tom Gayner because he's obviously, he's him and I'm me. And so I just don't know how they can track that many companies. And so I just wonder, to me, I don't see the benefit of that, but again, I'm not Tom Gayner and he understands what he's doing. So I question that.
Yeah. I mean, I think it comes down to what game are you trying to play? Like you said, one of the things that I probably do too much is trying to micromanage my portfolio. As much as we talk about finding great businesses, finding those that compound over a long time period, that means not touching it, right? Like constantly checking up on every single position is kind of the definition of micromanaging in a way, right? I mean, you're kind of like trust but verify,
Right.
You're kind of doing that. But at the same time, like it goes to what kind of businesses are you trying to look at? What kind of results are you trying to get? Are you trying to hit home runs? Because if you have 100 stocks and you just need one home run out of those 100, and that's the game you're playing, then that one stock will carry all the losses and you don't need to micromanage. So there's so much complexity to that and nuance. But I get it. I get it. Yeah.
Right. Yep. I get it as well. I mean, there's a gentleman I follow on Twitter or X that he literally owns two companies, Palantir and Robinhood. And that's it. Those are only two companies, and he picked the two of the most volatile ever. But that's what he owns, and more power to him. I could never do that. As much as I love, Berkshire and Visa, for example, I could never just own them. I have to have some other level of diversification to ensure that I'm not wrong. And maybe that's my curse, is feeling like I don't know enough. And so by spreading my bets to a certain extent, that helps offset that feeling, if you will.
How much money is this gentleman investing into those two? Like, are we talking about his life savings?
Yeah. I mean, well, yeah. I don't know if it's literally his life savings, but everything he invests is in those companies. I've been following him for 4 or 5 years now, so I gotta expect it's not small amount of money.
But he hasn't said straight up, "This is my life savings."
No.
Okay, so all right, so we could be talking about
it could be literally $200. I mean, I literally don't know.
I have a lot of problems with that. I just think it's bullcrap. Like Palantir and Robinhood, give me a break. If anybody is following that, then I guess a fool and his money are soon parted. But like, That is a terrible, like, should be an investing show, you know. That's kind of been the idea from the beginning. That is not investing. That is speculating.
Yeah, it's definitely high on the risk tolerance factor for sure.
It's not investing. It's not. And neither is putting like half your money in Bitcoin either, by the way. That is
No.
not investing either. Even though people call people like that investors, it's
Right.
not investing, it's gambling.
Yes. Totally agree. So what are your thoughts on the whole equal weighting versus weighing per conviction?
Yeah, I think again it kind of comes down to what are you trying to play. I remember we had a discussion in the past about like one of these light bulb moments I had. A lot of quality investors talk about how they want to put the most money into their highest conviction ideas because they're not going to have as many. If you're more like me, more on the numbers side, and you look at valuation a lot, that's probably a terrible idea to do, because you could argue that some of the stocks with the best valuation discounts can be the most riskiest and they might be a high conviction on a numbers basis, but that's not necessarily high conviction on a business performance business. So if you're playing the numbers game, you're playing with probabilities. It doesn't make sense to base your sizing on conviction because you're playing the numbers game. I don't know if I'm making sense, but when you play the numbers game, you're playing that over time. Not every stock's going to be a winner, but I'm going to have enough winners because I'm playing the odds are in my favor. If you kind of mix that with this idea, well, I only get one or two good insights in my life and I'm going to put a bunch of my money in my best idea, that's two different things. And I think you can get in a lot of trouble, myself included, when I start to think about which stock do I have more conviction in, which stock do I want to put more money in. It should be more, what's your special insight? What's your special way that you interpret the business quality of this business? And by definition, it should be special. You shouldn't be having these special insights every day.
Right. Do you think the way that the style of it that you invest in, i.e., putting $150 in at the beginning of every month, do you think that lends itself more towards maybe not necessarily equal weighting, but maybe more towards that as opposed to air quote using the elephant gun, Warren Buffett, going out and buying big? Do you think that has a bearing on it as well?
Yeah, I think so. That's really insightful. The nature of it, of always putting money in, does make the portfolio, if you're trying to balance it out over time, it does turn it sort of equal weighted. Definitely more so than like, because if you have a high conviction on one idea and you try to do that with a dollar cost averaging approach, you're basically just 10 months in a row, you're going to buy the same idea. So
Right.
to your point, like that's not what I'm doing with my newsletter. Not at all. So, yeah.
No, not at all. I mean, as much as we would all love to buy Costco 10 months in a row, it's probably not realistic. So maybe getting back to the portfolio construction for just a minute, when you think about total number of positions, for example, like you were talking about 6.25% or 6.5% for allocation, if you will, how do you think about like when you start to bump up against, like, is there a finite number you feel like, okay, this is enough? Or do you think that it just kind of builds on it for, eternity?
Right. For me personally, I'm pretty close to that where it feels like enough. And maybe that's what do they call when you get attached to the stocks you own, there's a bias effect about that. I'm blanking on what it's called.
Yeah, I am too.
Not attachment. Is no. There, if you study psychology and you look at Kahneman's work and things like that, behavioral psychology, there is a literal bias where everybody has different emotions, different brain chemicals about something that they particularly own something they have an ownership stake in versus not.
Mhm.
And so that could be what I'm facing with my portfolio, where I feel so good about so much that's in there that I'm not spreading those bets out. I have a lot of full
Mhm.
positions. My full positions make up probably 80% of my portfolio right now. So
Mhm.
take 80 divided by 6, there's probably 12, 13, 14 full positions, depending on how
Mhm.
you define full position, that are in there. And I find it hard to part with those because I still
Mhm.
feel very confident about the long term prospects. But again, that could be a bias. And
Mhm.
that's just what I've come across over the last 5 years.
Yeah. One of the things I've noticed is that to me, the longer you own a company, the more it feels a little bit like your local sports team or the team that you follow,
Hmm.
football, baseball, basketball, or whatever. You get to know those players because let's say, you watch the NBA and I'll pick on the Timberwolves. You watch the Wolves play 82 games in a season, you get to know all those players very intimately and you think they're better than they are because you have a familiarity with them. And so sometimes I feel that way about my companies, the companies that are in my portfolio, because I've held Visa for 5 years. I feel like I know that like the back of my hand. And so I worry that if Visa starts to turn for whatever reason, am I going to recognize that, or is it going to be, the bench player on the Timberwolves that, yeah, he's a good player, and I know he's done well in the past, and so I'll keep hanging on to him, kind of thing. So that's one of my concerns when I'm thinking about managing, the portfolio and how it's constructed and whatnot. So that is definitely, I think, something to keep in mind when you're thinking about all this stuff.
Yeah, I love it. I mean, I think it's very wise to have that kind of self awareness. And it's a
Yeah.
very good thing to have. It'll help you with your investing.
Yeah. So when you think about diversification, maybe not necessarily versus concentration, but just as a general rule, when you're trying to build a portfolio and the one you've built, does that really play into, like, when you get to 25, 30 companies, do you feel like diversification still impacts your decisions on buying new companies, or is that something that is maybe more earlier on that needs to be focused on?
If I put myself in the shoes of a stock picker, yeah, it's probably something that you care more about as you're building a portfolio out.
Yeah. I would probably agree with that. I think at some point, I think that becomes lesser and lesser of a concern than it does early on. Like, you don't want to have 7 payments companies in there out of your 10 portfolio.
Right.
You want to spread your bets.
Yes.
All right. So let's talk about maybe some management stuff. So how does buying a new company enter the equation versus holding on to something or adding to an existing portfolio?
It's a tricky balance just because I mean, like for me, I'm always looking what's in my portfolio and is there something I can add to. But again, because we're fighting against our emotions, we're fighting against our biases, it's very easy, maybe too easy, to default to that. Where if you're never stepping out on a limb to buy something new, then you're just kind of sticking to your group of companies, which is great, especially if you've done a good job picking those companies. But how long will that last before new types of businesses or new companies that you never had on your radar because you never really cared to look or even take a risk on? Kind of like the innovator's dilemma in a way. A lot of tech companies go through this where they have their bread and butter of their business and they want to still make sure that they're doing enough things where they can be aware of whatever trends are out there, right? I kind of put that mental model on the portfolio management a little bit. Might not be the perfect parallel to that, but
Mhm.
if you are too cocooned in your own portfolio, then there's a risk that you are not attuned enough to what's going on outside of the portfolio, which can be missed opportunities. It could be disruption risks to the companies in your portfolio. Again, I'm not trying to talk in absolutes. I'm just saying there's higher risks because of the emotions involved. And so if you can strike that balance with the intention that this will help me with my emotions and put me on the right path so I have more guardrails, I guess, then yeah, I think it's a good idea to try to have a balance like that.
Yeah, I agree with that. And that's something that I know I struggle with, is that Peter Lynch idea that he mentioned about sometimes the best idea is the one you already own. And that unfortunately is stuck on permanent loop in my head. And so sometimes when I'm thinking about, do I buy something new or do I add to what I have, that I have to fight against that permanent loop of, Peter Lynch said, Peter Lynch said, Peter Lynch said.
I'll help
Because
you
to your
break it.
point,
You want me to break it for you? I'm gonna
yeah,
take
you break
I'm
it,
gonna take a sledgehammer and just smash it down.
smash it to bits.
Yeah, Peter Lynch held stocks for on average a year and a half.
Yeah, it's a very good point. And he
He
also
was
had a gazillion of them too, didn't he?
he did, yeah. And he would buy something, it would skyrocket. He'd buy a little more, and then he'd be out in 6 months.
Right. Yeah, that's a very good point. So it's ironic that I have that on permanent loop in my head, but yet the person who stated it did not follow that advice in any way, shape, or form. That's funny.
Yeah.
Thank you for taking the sledgehammer. That's
You're
very,
welcome.
very helpful.
You're welcome.
All right. So I guess kind of moving past that, how do you think about the timing of the companies you own? So the question is when to trim versus let your profits run. So to me, that's like, when do you trim versus the Charlie Munger idea of not interrupting compounding?
Yeah, 100%.
How do you balance that?
I go back to the thing that you and I have been preaching for years and years and years, ever since Gilbert put this in repeat in my head. If you're a long-term investor like Dave and I, when do you sell stock? When the fundamentals of the business have changed. So if you're buying these stocks and intending to hold them for years and years and years and years, then profits are a good thing. Profits are evidence that the company is growing. You don't have to take those off the table, because if you're a business owner, it's just evidence that the company is growing. And if you think it's going to continue to grow, then don't worry, there will be more profits. You don't have to take them now. I think that kind of mindset sounds simple, sounds easy. It's not easy, but trying to remind ourselves of that. Because if you focus on the business rather than the stock, then you can analyze, okay, maybe the business has changed. Maybe the recent struggles and the stock price going down is because everybody's figuring out that this company, their glory days of 10 years ago are no longer. That's a good reason to sell. But to sell because the stock's up 300% and I want to lock that in, not always a great idea, especially if you're investing the way we are.
No, exactly. Something I don't remember who said this, but one of the ways to achieve an idea like a 10 bagger, for example, is you got to hold on to the company long enough for it to actually achieve that. So it's easy to say that you're a long-term investor. It's easy to say I want 10 baggers or I want 100 baggers or a 5 bagger or whatever. It's easy to say those things, but to do it, you actually have to hold on to the business. And I think the key point that you said in that is, when you analyze the business and disassociate that from the stock price, it becomes easier to look at what's really going on with a company, because sometimes the price volatility can shade our thinking. And if we can remove that from the equation, it becomes easier to go, okay, to your point, are there glory days in the past? And maybe I didn't notice that because the stock price kept going up, and now all of a sudden now it's not. And the rest of the market is catching on, and maybe you're a little slow to the punch. So that could be the issue. And I remember when we looked at Alibaba a little while ago, and if you took the name out of it and looked at just the financials of the business, it looked like a great business. But because you're looking at the name and the price, then all those things get skewed. I think that could be a really helpful way to analyze a company, is to try to figure out a way to, you know, put tape on your screen or something where the price usually shows up so you can't see it, as a way to help you focus on the business. And that's I think a fundamental part of investing, right? Is understanding that we're buying a piece of a business. And if we can remember that when we're thinking about what new companies we want to buy, what companies maybe we want to exit, and how long we want to hold those, if we think about the business itself, I think that can start to answer a lot of questions. And I guess the last thing I would throw out there about this is, when you're thinking about buying or holding a company or letting it run, for example, if you don't have a basis for your thesis, you're never going to remember it. So, i.e., write it down, type it out, put it in a notebook, put it on a notes on your iPhone if you have an iPhone. Somewhere on a Samsung phone, I'm sure they have a notes kind of thing. You never use one, so
Hope so.
can't speak to that directly. But there is a place in your life for you to write something down. It doesn't have to be the next great opus or Shakespeare. It can literally be 4 sentences, and write it down. And then when you're thinking about these questions, refer back to that. When you're analyzing Berkshire Hathaway and you go, yeah, I bought it because of this, this, and this, and then you're analyzing it, answer those questions. Are those things still in play? And if they are, okay, fine, move on. I think that could make a lot of these questions a lot easier.
I love all of that. I am taking the sledgehammer and I'm banging it on the floor and like applause and confirmation, because that was awesome. The last point from Ashish here, he wants to know about rebalancing. He's asking, is rebalancing necessary? So what is he talking about, and what are your thoughts on this?
Rebalancing is basically when I frankly haven't heard it talked much about individual stocks, but I suppose it could apply equally. It's usually associated with portfolio management of index funds, mutual funds, things of that nature. And basically what it means is, if you have a particular allocation to a certain style or size of different positions, then at least with my 401k, every 6 months, they would rebalance the portfolio. So let's say that I had a 40, 20, 20, 20, in different buckets. If one of them got up to 55 and then the other ones were lower, then they would sell the 15 above to get it back to 40 and then reallocate those to the other ones that were lagging. And that's what rebalancing was. I frankly haven't heard of that in individual stocks, but I don't see why it wouldn't apply if you wanted to have 20 positions at 5% each and 2 of them got up to 10.5%, then you'd have to sell the extra 5% and allocate that to other ones that were lagging. I'm frankly not a fan of that in individual stocks, because it kind of goes against what your profits run. You're basically cutting them off at the knees to, air quote, water the weeds, so to speak. Could be. I mean, all 20 could be bangers in your portfolio. I'm not saying they aren't, but in theory, you could be cutting the flowers to water the weeds, and that's not what you want to do. So I guess I'm personally not a fan, but I know it's very common in the index funding world.
Yeah, I agree with you too. It's hard enough to find great businesses that can stay great. And then you want to also throw on this loop that once I find a great business that stays great, then I'm going to sell it because I have a rebalancing rule. And then you got to go find another one. It's tough.
Right. Yeah, that's really, really tough. Yeah, it's really tough. Our friend Brian Feraldi has been on the show a lot. He talks a lot about starting positions that were around 3% and then just letting them run. And so they earn the position they have in their portfolio. So I think that's, a really good idea. And I like that idea. So I personally don't feel like rebalancing is really necessary.
It's the opposite of rebalancing. If rebalancing is cutting and trimming your beard, Brian Feraldi's just letting it fly. I like
exactly. Yeah, me too. It's even more ironic because he's bald. So
right.
there's that. So
Let it loose.
Let it loose. All right. Well, with that, folks, we will go ahead and wrap up our conversation for today. Wanted to thank Ashish for sending us these fantastic questions. I hope that we answered them sufficiently for you. If you have any more questions, please feel free to reach out to us. And if you have any other questions about anything else, reach out to us at newsletter@einvestingforbeginners.com. We do read them, as proof today exists, and we will answer them on the air for you. So with that, go ahead and sign us off. You guys go out there and invest with a margin of safety, emphasis on the safety. Have a great week, and we'll talk to you all next week.